Good morning, everybody, and welcome back to Solar Finance and Investment Europe. So we're going to start our second panel for this morning very shortly. A few housekeeping notes from my side beforehand. So you will be able to watch videos on demand if you miss any of the sessions throughout the next month. So do keep an eye on the platform. They normally go up within a few hours, so they're not immediate, but they are available for you to watch on demand. The platform stays open until the end of March, so you have a good sort of chunk of time to watch anything that you may have missed. Don't forget as well that apart from today and tomorrow, we have a whole month of content for you. So today and tomorrow, we're kind of looking at the content that's relevant to everybody in the market. And then for the rest of the month, we have our country focus panels. So each country will have a panel discussion and interactive workshop for attendees to speak to panelists. We're looking at Portugal, Spain, United Kingdom, Republic of Ireland, Poland, France, Denmark, and I feel like I've forgotten a country. But do check them out because they will kind of look at some of the most investment opportunities across Europe this year. I'd like to say a very big thank you to our sponsors. Co-sponsor today is SMARTENERGY. We're also supported by Huawei, Grand Solar, Trina Solar, Jinko Solar, and Longi. We also have a great, fantastic group of bronze sponsors, Axpo, DuPont, PV Hardware, as well as supporting sponsors, Exergy, Rena, Telus, and Solus. You can check out their virtual stands in the exhibition. They've provided a lot of content that's useful for attendees, so do feel free to sort of check out and arrange a meeting with the team there. I think that's more than enough from me, so I'm going to pass over to our host for the next panel this morning, Louise, who joins us from EY. We're going to have a look at the future of the solar industry. So a few teasers for you. We're going to look at auctions, we're going to look at green hydrogen, and the way that the industry is changing and evolving this year and over the next coming years. So Louise, I'm going to hand over to you and ask you to introduce our panel this morning.
Great, thanks, Jo. And I'm delighted to be here this morning with a really fantastic panel of experts to talk through the rather sort of lofty topic of the future of solar. So we'll be getting our crystal balls out and looking at what I think will be a very bright future for the sector. Just a quick introduction to me first off. So I'm Louise Shaw, an associate partner at EY. I'm sure you've heard of Ernst & Young or EY as a global professional services company, but we're very committed to sustainability and gender, having announced that we were carbon neutral by the end of last year, and indeed that we'll be carbon zero by 2025. We've got a team of around 35 people based in the UK, focusing on advising in the renewable energy and indeed broader energy transition and agenda. I've been in the sector since 2008. And I lead the solar sector activities, so we advise around M&A and financing in the sector. So I think that's enough on me. So I think we've got a lot to talk through. So I'm just going to delve into the meat of the discussion, if that's okay. So I think that the first topic that I'd like to just talk about is indeed how the structure of the industry might evolve over the next few years. We've obviously seeing a lot of increasing interest of particularly sort of strategic players, the likes of oil and gas, coming into the sector. But I think the financial has really been a point of consolidation for the sector. And Federico, if you could just introduce yourself and just talk to how you see, whether you see that dominance of financial players continuing.
Good morning, everyone. Thank you, Louise. First I introduce myself. I'm Federico Giannandrea. I'm a partner at FORESIGHT. I'm head of FORESIGHT for continental Europe, overseeing our operations in continental Europe, and we have 3 offices: Rome, Madrid, and most lately Luxembourg. In terms of the role of the financial players in the solar market, obviously I think we've been experiencing over the last 2-3 years a little bit of a shift this is a very crowded market that sees many other players actually looking to enter this market, and they actually have done in the next couple of years. In particular, we have seen the fact that the oil players that before were not looking at renewables are now very much concentrating on these investments. And on top of those, I think that there has been a refocus on this type of infrastructure by many of the infrastructure players, whether those are funds or which are, let's say, dedicated funds, or even pension funds and insurance companies, which have been investing over the years in a wider variety of infrastructure sectors, which during the pandemic went into a little bit of a crisis. If we look, for example, at what happens at the investment in airports, ports, toll roads, and other type of infrastructure, we have seen the fact that the resiliency of renewables has brought many of these investors to rethink their portfolio allocation, and therefore plunging a lot of money into renewables, and solar in particular being probably the simplest technology and virtually the easiest to manage asset class. At the same time, I see that the financial investor will continue playing an incredible role in this market, although transitioning from, let's say, typical feed-in tariff environment into much more merchant base. Clearly, some of the financial investors will struggle not being capable of locking and securing long-term revenues. And therefore, this is where the game is going to be played. Either we change a little bit the approach to this market, and the financial players become a little bit more industrial, and by saying that, that doesn't mean they need to become a utility, but then at the same time, I think they need to equip themselves in order to be capable of having an in-house, let's say, desk that trades electricity, and therefore being capable of coping with the fluctuation and the volatility of the commodity. Otherwise, clearly, their role over time will kind of shrink. And then there is the other argument, which is at what point the race to the bottom will actually cut out the financial investors, in the sense that clearly the financial investor is targeting a certain amount of returns, which are an effect of the cost of capital of their LPs, and on the other, the performance that they can have, and therefore the alignment of interest between what they can achieve and how much they can extract in terms of carry from their funds when they do this type of investments. And I see that, for example, below the 4% mark, I think that the financial investor will stop playing such a key role, and then clearly those industrial players, sorry, not partners, those industrial players, I think will take over if that happens. So that would be my view on the subject.
Brilliant, thank you. Some really interesting points that you raised, and I think we'll come on to talk about the sort of how the cost of capital will evolve, and indeed whether it can go any lower. But before we come on to that, just want to bring in Joost, if that's okay, because I think this topic of sort of financial players almost becoming strategic players is quite interesting, and the extent to which they're having to bring in those, trading and operational capabilities in-house. And yeah, so just interested on your views on that.
Yeah, thanks, Louise. Good morning, everyone. So I'm the managing partner at GLENNMONT Partners. We've been active in clean energy infrastructure for about more than 10 years. So pretty early mover. We collect capital from institutional investors, pension funds, insurance companies, banks, and so on, and invest that in the clean energy space. And solar has historically been a very large part of what we do. And a couple of points to the observations that Federico made that I really concur with, and looking at it through the lens, I suppose, of institutional investors. So first is, I think that solar, if you look back over the last 10 years, investors really like solar, as opposed to, I suppose, onshore wind, offshore wind, and bioenergy. I'm not suggesting that they do not like these three big sort of other core technologies in clean energy, but solar, in my perception, has been the one that has been most predictable. And then predictability, solid, predictable cash flows, that is what conservative institutional investors typically look at. Solar has not disappointed, whereas wind, as I'm sure, let's say that's not today's topic, but a couple of people on the panel know, has been quite volatile. Investors have been sometimes burned by wind forecasts. Solar actually has held up very nicely to sort of the forecast. The second thing I think is that there has been, as we all know, a large panel shakeout now, I guess 5-6 years ago. When we started 10 years ago, there was a plethora of panel providers. Everything was done locally, pretty poor quality. There was, let's say, a plethora of construction companies, and there's been a lot of consolidation. So I think the combination of solar assets holding up very nicely to the forecast. Secondly, I think that you're now dealing with, I don't know, 10 or so, quite a few sponsors today, very solid solar panel providers. Solar also becoming very, very cheap, whereas let's say bioenergy and wind are sort of, yeah, catching up a little bit. This is what I think, let's say, that very solid track record, I suppose, is the word that I'm looking for, is what institutional investors really like. Coming back to your question, look, I mean, there is a lot of capital at institutional investors to finance the energy transition. I think it's accelerating after COVID. The Build Back Better, I think, is really resonating very well with institutional investors. They don't need, let's say, Joe Biden to say, go invest in solar. I think they're already onto that and very actively. And with that track record, I think they're very interested. Now, will they indeed finance merchant power plants? They probably won't be at the front end. I would say, let's say, where institutional investors can pick up a big role is picking up the stock. So a lot of investors, they are quite happy initially to invest in the older assets that have been built, let's say, 3-4 years ago and before, that still have 20, but that will allow capital to sort of recycle and free up from funds like ours. And then that sort of capital will then drive more into the newer flow, I suppose, that will be more merchant driven. So that's how I see it shaping up, that I think a lot of institutional capital will go towards sort of more brownfield capital, picking up assets that are de-risked, that are well performing, and then they will sort of use funds like us, I suppose, to help them structure transactions where indeed you need trading skills, PPA skills, merchant skills. But I am positive that institutional investors with the right sort of intermediate company will be quite willing to allocate significant amounts of capital to solar. I'll stop there.
Thank you. So Michael, I'd just like to bring you in at this point in the discussion, because I think it's very interesting, as you say, that the sector diverging between the sort of brownfield race to the bottom and the greenfield. And I think there's certainly a trend of some investors getting earlier in terms of the development life cycle and doing joint development agreements, etc. And just interested in your thoughts on that, Michael.
Louise, thanks for bringing me in. Just a few words on my side. First of all, a very warm welcome to the audience. I'm managing director of KGAL Investment, and we've been in the industry for nearly 20 years, so kind of a dinosaur within this group of panelists. So we have seen the whole development of the solar sector, buying into assets backed by feed-in tariffs at horrific high cost, but still attractive for investors. And we have now coming to a situation where, according to our beliefs and our understanding of the market, brownfield investments does not make sense in the current situation, does not make sense for a financial asset manager like KGAL. Returns are too low, there's too much capital in the market, and too few projects available. Yes, there is a huge stock of assets, but still there's a huge battle on these assets once they come on the market. That's the reason why we have shifted our focus to add value for our clientele, for our investors, by entering the value or risk curve earlier than in the past. So we are teaming up with investors. We are clearly understanding the market. We are clearly assessing risk and assuming those risks. And after all, we try to add value to our investors by capture those margins, which in the past have been captured by developers, by EPCs, module manufacturers, and increasing returns to our investors, but also have a clear focus on asset management, because it's not sufficient just to capture margins during the development and construction process, but you have to also maintain value through an active management and also increase value of assets by active management. So we are kind of in the process becoming an IPP, but we always clearly ask ourselves, make or buy. Is it the right thing to buy services, professional service on the market, or perform some services in-house? And for the time being, we have decided to have a fairly high amount of technicians within our asset management department, but more or less to supervise and to monitor external service providers to create such value, because as of now, size of the market, we believe specialists can perform better services. It's our task to monitor and steer those service providers during the asset management phase. Finally, there are still situations where we believe it makes sense to acquire operating assets as well for our investors. So we have a mixed strategy in that, but this clearly requires a kind of under management or a special situation for an operating asset. Just buying in a asset at COD with no issues, I think we cannot create the necessary returns for our investors. It makes sense maybe for investors who directly invest in those assets and learn their lessons, because it's not as easy as it looks like to operate in solar, even the solar assets.
Thank you. And David, I'd like to bring you into the discussion now, just to firstly introduce yourselves, but I think coming from the other perspective perhaps, and having two backers with incredibly deep pockets, just how you see the shape of the industry, please.
Okay. Hi, good morning, everybody. So thank you, Louise. So I'm David Díaz. I'm the Chief Financial Officer of X-ELIO. So in fact, I'm brand new to this sector. So I come from the banking sector and transportation and telecommunication infrastructure sector. So joined X-ELIO a year ago approximately. And well, we're a global solar company. Present in the Americas, in Europe, and also Japan, Australia, and owned by KGAL and Brookfield. So two, large, very, very large financial investors. If I may just, a quick comment on this financial strategic investor type that Federico and Joost mentioned. So I would agree with what was said. So I would say that, I had this discussion in the past many times. So usually, financial investors, or the so-called financial investors, what I have seen is that they do not only provide financing or equity. So they also have strong teams. Also global platforms, vertically integrated in many cases. So they can provide a lot of insight, a lot of support in procurement, in operations, not only in financing. So I would agree that today, the difference between maybe industrials and financials, there is a very, very gray line. So I think that's important. And I would say that, the sector today, it's is one of the, I would say, most promising sectors. So it's demonstrating during the pandemic, during the COVID, the resilience. I think it was Federico that mentioned, in comparison with other infrastructure sector, like maybe transportation, where investors look for, if I may say, predictable and visible cash flow. So energy and renewables in particular has been a sector absolutely resilient. So even in terms of prices, the companies or projects that were not didn't have a feed-in tariff regime or didn't have a PPA in place, and that they had merchant exposure, I would say that in general, the impact of the reduction has not been as relevant as maybe in other sectors. So in many cases, there's maybe 15-20% reduction in terms of revenues. But if you can offset and manage this with other, with other management, you can have a very, very decent and resilient cash flow profile. So this, I would say, in addition to all the initiatives by different sectors, ESG, that it's becoming absolutely important, activist investors that are putting money in just specific sectors. What we see is as enormous, flow of money coming into the sector. And of course, when you compare supply and demand, it's true that this may take prices up and returns lower. But I would say, and the mention in terms of returns, I think is interesting. It's true that returns are completely different than the ones that maybe, these sectors or other sectors had years ago. But it's true also that if you compare to risk-free returns, the German bonds, American bonds, other European country bonds, they're negative. 10 years are minus 0.5%, 0%. Inflation also, the forecast of inflation is very low. And this, I would say that financing also, in many cases, financing spreads are very, very competitive. In the end, there has been a clear reduction in the cost of capital and the harder rates by investors. So I would say that it's true. Returns have compressed. But I think it's important that each player, each company has its own strategy. Efficiency is very, very important, and we believe that there is still significant room to make, I mean, reasonable and very interesting returns in this sector. And regarding Joe's comment, that was Michael, sorry, if I may also add, I mean, clearly, if we compare to more than saying brownfield, greenfield, if I may say, early stage projects versus, I mean, projects already in operation, I would agree that today many investors are seeing that, I mean, the projects have limited risk in terms of construction, in terms of financing. So it's not really complex, I mean, to build a project. So there is not high volatility in terms of the construction prices. There may be some issues in terms of delay, but compared to other sectors, I would say that construction, financing, I mean, there may be some basis points in terms of different versus the expected in terms of leverage. But I would say that today, projects significantly advance in terms of permitting and in terms of land, I mean, securing land. I mean, investors, we do not see a strong difference between buying a project, operating project with a PPA in place or with a feed-in tariff regime, with financing in place, with an EPC that you can transfer the risk to a construction company versus, I mean, projects that are already operating. So it's true that today we must be innovative to look for, I mean, interesting and attractive returns.
Thank you. No, some really interesting points that we'll pick up on the discussion. Ivan, I just want to bring you in to introduce yourself, if that's okay. I think a couple of points, if you can come back on. Firstly, the sort of, you know, premium over risk-free rates that the solar sector, will that continue to compress, or is it purely a sort of factor of the market, the fact that returns are declining? And secondly, do you see a sort of trend in terms of disintermediation and institutional capital coming directly into the sector, or do you think there will be a continual role for fund managers?
Perfect. Let me see if I can answer you the second one. The first one, I will just tell you my guess, because obviously I'm not, let's say, so focused on the financial side as the rest of the panelists. So Iván Higueras, managing founder of Grand Solar. We call ourselves an energy solar platform because we basically incorporate all the services, you know, development, EPC, O&M. We have a manufacturing of trackers and controllers, and we also have the solutions where we do storage and basically project development. Basically, on answering your second question, what we see, our customer is changing. So the customer that we used to have 5 years ago, or our core customer, was basically a specialized IPP that will not, let's say, hold on to the asset for not even the construction period. And now we have more and more funds like, you know, X-ELIO, where we're working with, and hopefully also, you know, GLENNMONT and others that we are offering, which are basically platform for, let's say very competitive capital, getting upstreams, getting in with us in the early stage of the development, and trying to capture value that. And they capture that not only by placing money, I don't know who mentioned that, or competitive money, but making ourselves have visibility of the pilots that we can develop, making ourselves have a prediction or forecast or how much we have to invest in our teams, both for development and construction. And that's how we've seen the industry basically evolving. So that's obviously, if you added that with all the competition that we have in with this transition from feed-in tariff that we have back in the day, some of us, like Michael was saying, 20-year experience, we only have 16, but we feel like dinosaurs as well. So feed-in tariffs are gone. Most of the places, auctions are trying to be dividing markets, if you may. So there's within a market, there's people who go to auctions and people who like to go through the channels. We haven't, again, and please open to discussion, because I only seen from my side of the value change. I don't see competitiveness in margins or the cost of capital more than bundling. What I see is that the guys who have volume, who have platforms in the market or in the country, they are able to, you know, compound that risk and have a better, let's say, proposal for the service provider like us. And I guess they get better terms and make their financial models run better. I don't know who mentioned that there is too much money in few projects, chasing few projects. I don't think it's a cost of capital anymore. It's more having the volume and the platform on markets and then having advantage to that. That's what we're seeing from, let's say, a service provider or developer point of view.
Great, thank you. And João, just like you to introduce you, if that's okay, and bring you into the discussion. I think one of the interesting evolutions of the solar sector currently is how it fits in with things like co-location, storage, and indeed green hydrogen. And I'm just interested in your perspectives around what that means for the shape of the industry, and indeed what sort of capability participants will need as this sector evolves alongside other technologies.
Okay, first of all, I would like to thank Solar Media for the invitation to join this panel today, and welcome to the audience. Just a brief introduction on myself. I'm working for SMARTENERGY Group as the COO and the Deputy CEO. The SMARTENERGY Group has been present in renewables since 2011, so we actually are turning 10 years now this year. And we have been developing our activity in renewables from an investment and development perspective, in technologies like solar, wind, and green hydrogen, as you just mentioned. Presence in Europe, in countries like Portugal, Spain, Italy, Germany, and somehow present throughout the value chain. So we have a very, very strong skills on the development side with the boots on the ground and teams in all the markets where we are present. And then we follow the construction also to assure the quality and to make sure that we receive the right asset at the end. And then also on the operation phase, we deliver asset management for the projects, and indirectly we also hold the assets through participation into IPP. And coming to your point, I guess I have heard today the need of trying to somehow make an evolution in what we have seen in this renewable sector that has proven to be during this pandemic quite strong and robust, and the need to somehow tap in different sources in order to, in combination, to extract the right level of returns that each of the players, each of the investors is looking for, depending on their risk profile and requirements. And definitely the diversification on the technology side, or on the somehow evolution on the type of projects, call it hybridization or sitting together different technology, is becoming quite important in our view. And the reason why for more than 1 year, end of 2019, we decided that the movement from what we were doing so far, solar and wind, needed to be the green hydrogen. So somehow we have saw that the market will come to a point that all the players in renewables cannot walk away from this new opportunity, if we can call it like that, the green hydrogen, because the signals in the market are clear and evident. And we do believe that this combination of different kind of revenues, which result from this combination of wind with solar, storage, or also the green hydrogen, where you need existing renewables or increase or create new capacity in terms of renewable generation in order to feed the electrolysis process in order to generate the green hydrogen. So I would say that this is one of the axes that all the players in the industry should follow, in understanding that the old times of the feed-in tariff regime, where we have seen a boom in renewables to support the deployment that was needed, and now we all are quite happy and excited by solar becoming the low cost of energy generation, but this will pose another challenge to industrial, to financial investors, where to extract the value. And also this comes with you expanding your presence, not only on waiting for the asset to be delivered to you, but also to go a bit along the value chain in order to have the right projects with the right quality, and to be able to deliver to you the returns that you are expecting, and somehow where you establish your investment criteria.
Thank you. David, just interested in your perspectives on this trend around the sort of multi-technology and how that plays into the future.
Yeah. Thank you, Louise. Yes, on complementing what João has mentioned, I think it's very relevant, because clearly hydrogen, storage, I mean, the market is now changing, and clearly second half of 2020 and 2021, hydrogen is becoming like a boom every day in all newspapers. I would say that it's very relevant for the sector, even if in a project a developer or an investor is not considering any kind of whatever or hydrogen pairing or storage. For the forecast, for the 35-year forecast, and when we mentioned that most of the cases, a project may have a PPA or warranted revenues for a certain period, but the impact of merchant prices is very relevant for the profitability of the project. I mean, the assumption on hydrogen, on what the importance of hydrogen in that country, in that region, that's very important for the forecast of prices. So in terms of penetration, I mean, electrification assumptions, I mean, subsidies, the CO2 price, and if we were to request, I mean, reports to a consultant, a market consultant, depending on the assumption of hydrogen, I mean, the expectations, merchant price may significantly differ. So I think that this is very important, even for a standalone project. On the other hand, and now going to the, hybridization that João mentioned, I mean, some projects where there may be some issues or some question marks in terms of profitability. I mean, depending on developing the project with additional investment in terms of storage, or even with electrolyzers to produce green energy, so that then the project may be viable. So I think in both cases, I think that these technologies, it's true that it's in some cases or for some specific countries maybe a bit early. So there are a lot of question marks on what's the percentage of subsidy today that hydrogen may need. But clearly, I mean, the governments have given a clear signal that they want to boost the production of green energy. So the impact that this will have in the following years will be paramount.
Thank you. And I think, there's some obvious benefits to that sort of diversification from a technology perspective, but from a financing perspective, there's some, very real challenges, particularly around green hydrogen, indeed, storage, and obviously that's a slightly variable picture in terms of different markets. But Federico, just interested in your perspectives, when will your investors be ready for that kind of diversification? To what extent does that help your fundraising and attracting capital?
I think there's a difference between the storage per se and the hydrogen, and I think that the two things are separate in that respect, and in the preparation of investors to the field. I think while the storage already has its mainstream, if you wish, there are a number of funds listed in the London Stock Exchange that are dedicated to that. We have invested as Foresight probably 3 years ago in batteries in the UK, and but over time, the stability of the revenues of those type of investments and the lack of long-term contracts gave us, let's say, the view that the market needs to mature a little bit more for us to continue investing in that. We see the majority of the renewable energy players to be looking at, let's say, hosted batteries in their own plants, so that when the batteries are captive to their own plants. Clearly today, the sustainability of that kind of investments in terms of possibility of, let's say, playing an arbitrage in between the price of electricity is not there yet. So unless you have all the streams of revenues that stack up, the sustainability in the long term it is not as forecastable. I see Ivan shaking his head, so he disagrees, but then that's a good point that we can have in the conversation. A completely different story, it's hydrogen. I think everybody's looking at it at the moment. I see that to be a much more industrial kind of play. So I would rather see financial players or renewable energy players partner up with some industrial players to play that kind of role. I don't see pure financial players being capable of running a hydrogen factory or farm factory, whatever you want to call it, or plant, because it requires that technology and the skills to run those technologies. But I think that over time, the big renewable energy players will put a service their own plants and find agreements with industrial players to do so. An example of this is, for example, the octopus plants that are in Montalto di Castro in Italy. One of the selling points of the, let's say, of their sale, it is not a secret because it's in the public domain, is the possibility of using those plants for the specific location for the production of hydrogen. But then it requires obviously planning and then construction. So hydrogen, I think it takes another 5 to 7 years to become really a mainstream type of asset class. I think fund managers like us will be equipped by that point in time, but I think we're still on the study phase, if you wish.
Thank you. Ivan, did you just want to come in there around?
I'm sorry, Federico, because I have to say I agree with most of what you're saying. But I mean, we're very bullish in the stories, and I think we are presenting. I don't have all the details. Some of the projects to some of you guys that we're developing in Australia, which are standalone utility storage projects. And you're right. Over there, it's not about accumulating electricity or energy and selling, but selling services. The same as in UK, as you know, there's a lot of projects that participate in the capacity. But if you look to some of the projects in California, the numbers run. The numbers run, even having batteries in Nevada and just selling in the peak in the afternoon. So there are parts of the world where the numbers run. The problem is that it's very difficult to find early adopters, because we all have in our mind that this is going to be a cost curve line, and then it's going to be like solar panels, and then the storage is going to be like 30% of what it is today in 5 years. So obviously, unless you have let's say an urgency or a big opportunity, or maybe you are obliged by utility or regulation, you rather postpone the decision to put the battery. But what we've seen from customers is that everyone is asking for a storage ready design. I mean, all of our designs, I would say, from the last year and a half have either at the high voltage level or even on DC with DC couplings, they have these allocations. And in other markets, as you know, Portugal, also the coming, in theory, a new auction here in Spain, Australia, everyone is asking for this allocation. But sorry, Federico, if I
it's good to have a bit of
I agree on the fact that everybody's asking for the allocation, and but I think we're saying the same thing in the sense that maybe in California they work just doing arbitrage on the price of electricity, but as you're saying, if you don't have another kind of stream of revenues in some other markets, you struggle with the battery. The prices will come down. I think all of us will look at this in due course, and then how to change the current licensing that you have and make those assets that you already have in operation to be battery ready tomorrow is kind of part of the challenge. You need to change the way the connection works, so you need to ask for a different authorization in that respect. But I do believe it's going to be a strong market of tomorrow.
Thank you.
Let me add one question, that we always considering storage, battery storage as an option. But for the time being, we consider battery storage more as a grid asset rather than a generation asset. So similar to Federico, most of the revenue streams come from capacity or other revenue streams. Just betting on arbitration at least in our core European markets, we haven't been able to conclude a sustainable and viable business model for that asset. But we always think about, does it make sense to add storage to an existing PV project? And for the time being, we still believe, wait a time, and always the question, make or buy. Shall we make or shall we build our own storage asset, or shall we buy services from the industrial market?
And also to just a quick one to add on what Federico was saying, and we also see that the times that green hydrogen is now crossing somehow remind us what happened 15-20 years ago with solar and with wind, and clearly we see that maybe the financial investors are not the ones that will be now willing to jump to this opportunity as it happened in the past. So somehow there is a path that needs to be done, and we see much more as we heard here today, industrial utilities, developers with a different risk profile that somehow will need to pave the way in the next years. And we see the green hydrogen projects taking traction earlier in the next 2 to 3 years. And again, this is also this brings us to the discussion that we have early in this panel, which is how the industry, the sector is moving, and what will be the landscape of investors. And we see that somehow the market, and with the green hydrogen even more, is putting you in a position in the value chain that you also have to have the direct access to the market in terms of consumption. And at a certain point, there is the discussion of if finally you are going to deliver to your end customers through the energy sale in the market for residential, small and medium enterprises. If you are selling kilowatt hours, that we know the pressure that is suffering for the renewables growing is quota in the energy mix, or if you are selling kilograms of gas. So, and at the end of the day, I think this is also how it will be shaping the landscape of players in the renewable sector going forward.
Thank you. Just a couple of questions from the audience around hydrogen. It's obviously a very hot topic. Just interested in the panel's views around the sort of transportation of green hydrogen, and are we going to use existing gas networks for this? And I think also the longer term future of hydrogen versus battery storage. Appreciate they're very different markets, but which one has got the brighter future, I guess, or over the next 10 years? Federico, do you want to just come in on that?
It's a very difficult question. I'll take my crystal ball and give you what I see inside the crystal ball. I think that, as you said correctly, they're two completely different things. Okay, the route to battery is rather simple. They can be installed more or less in any existing plant, or they can be installed on a standalone basis. The construction of a hydrogen plant requires a lot more effort, and therefore the licensing also for construction of the plant will take longer. I think that while the batteries will naturally penetrate the market, or the market will be penetrated, whether you want to say it, in the shorter term, it will require far more time for the hydrogen, but also hydrogen per se doesn't mean anything unless we understand what will be useful. So it is not only the production of hydrogen on one hand, but what do you do then with the hydrogen once you have produced it? So it's either hydrogen vehicles or other technology applications. Is definitely one of the most abundant, if not the most abundant, element in the universe. But then at the same time, if we don't have a final market for the resale of the hydrogen, the two things will work. So that would be my view. And honestly, I'm incapable of forecasting what are all the multiple applications of hydrogen so tomorrow.
We won't ask you to stand behind that.
If I may, Louise, yes, we asked to add on what Federico says, and I mentioned this before, but there is a clear push from different governments, the European Union. I mean, we've seen the US recently. So hydrogen is here. So it's the future. It's true that there are many question marks in terms of profitability today. I mean, Ivan mentioned this. I mean, there will be for sure a cost reduction. So to what extent will be, what we have seen in solar or not? I mean, I'm not going also, I don't have the crystal ball here, but I would say that with a certain subsidy and many countries are ready, to provide subsidies for this. And also with all the advantages that this will have in achieving the, CO2 emissions targets. The advantages in terms of, ESG, environmental, and so on. So with a certain subsidy and with a certain pricing of CO2, I would say that projects may be viable for a private investor. So I would say with zero subsidy and then with a certain low level of CO2 prices, today is challenging that hydrogen is profitable. But clearly, we've seen in the past in many sectors. So this is, new technology, and I see that many countries believe that this is, if I may say, a good use of taxes, of the taxes to be devoted to subsidize hydrogen projects. So I think this is something reasonable.
And it's obviously one energy system, and solar can play a role in that. But just interested in your views as to how big a role solar can play in that, in our energy mix, and indeed the sort of deployment targets are pretty aggressive for solar, given the construction and development is relatively straightforward compared to other technologies. Please come in.
Yeah, no, look, I clearly, let's say it's highly interesting to talk about hydrogen, but the opportunity near term today, I suppose, is very much around solar. So solar is very modular. It can be installed in relatively small batches, but also in very large batches. Really the constraint is around land in particular. But otherwise, let's say solar is a very good, let's say, way to meet our renewable energy targets. Wind is highly dependent still, despite taller towers and so on really good locations. Whereas with solar, if you look at around globally, clearly most of the population lives in areas where there's actually pretty good irradiation. So there's a very good match between where we have solar resource and energy demand. So that's just a fact, right? So secondly, solar is really cheap. As I said, very modular. It's highly scalable. Like mobile phones and laptops, you can produce it pretty simple. There's no constraint around, let's say, base materials. Essentially, you're using sand, and I think there's plenty of sand. So all these things, I think, make solar the most, let's say, fast-growing technology, I would say, in the next coming years. So clearly, I think storage is pretty important because there is some demand at night. But again, let's say, if you look not just as where we have irradiation and where we have demand, but also how demand evolves during the day, again, there's a good match, right? There's large demand typically around sort of midday when you have most of solar irradiation. So again, solar ticks many boxes. Environmental impact of solar, very limited. There used to be panels that had some sort of environmental issues. Those are largely historic now. So the life of solar panels, some of the early ones, let's say, used in space, I think are still performing. So we're pretty confident they can use 35 years. So easy to operate. So lots of things, I think, that are highly beneficial for storage, for solar. So things to fix, clearly, storage, as we discussed, very important. There are different ways you can do storage. You can sort of, investors see this more holistically in the sense that they're looking at it on a portfolio basis. So you can have a mix of solar and also, God forbid, in this panel, dirty gas to sort of balance things out. So another way to sort of balance out peaks and troughs are indeed, let's say, having flexible generation that may be on standby, clearly. And I would say that institutional investors increasingly take a holistic perspective, I think, around building their own sort of predictable cash flow streams. How quickly can it ramp up? Clearly in Europe, the constraint is around land. That let's say it's not going as fast, let's say, because Europe is densely populated. But in other parts of the world, in Asia, in Latin America, in the USA, there are vast swaths of areas where you can really build very lots and lots of land. So lots and lots of solar with unused land. So I'm I'm quite bullish about the solar opportunity.
Thank you. I think, you know, the modular nature of solar is, as you say, the one of the real beauties of it as a technology. But I think one of the interesting trends that leads to is a sort of increasingly large mega projects, and at the other end of the scale, the sort of democratization of solar and smaller scale projects. Michael, just interested in your perspective as to how that picture might evolve over the next few years.
I would somehow disagree with Joost's statement. Somehow, we see clearly the trend to solar PV because the reasoning of Joost was completely right. It's cheap, it's available, land is in a vast area of the globe available for PV solar. But on the other hand, it's still intermittent. So we need additional zero emission technology like wind. And if you look at the forecast of any institution, there will be somehow a mix between solar and wind. Both technologies will form the basis of our future electricity generation. But on the other hand, we need therefore a new off-taker. And for me, hydrogen is a kind of new off-taker in the sector because they will consume additional energy provided by those intermittent sources. So without a new off-taker like hydrogen, the path of solar and wind power will be slowed down. And when it comes to deployment in the near future, everyone is hoping that the pace of the deployment is increasing. But look at the past. We see delayed projects in European countries. We see only a small portion of the requested amount of additional solar capacity is actually built and constructed. Germany, for example, is way behind its targets, and that's the problem in the more mature markets. Yes, there will be a huge growth path in Asia and in South America, or maybe even in the US, but core markets like Europe, there will be a lot of efforts which has to be done to deploy more solar capacity in the near future and in the midterm future. And to enhance this, of course, we need some regulation, but we will also need this new kind of off-taker hydrogen.
Yeah, just Michael, to react. So I'm not disagreeing. I don't think it's either or, and I fully agree that there is definitely a future for hydrogen. It's just, let's say that there are still quite a few technical bottlenecks to be resolved, and I query how quickly that can go. I mean, like Federico, I've got a crystal ball, but I would say it's probably a bit more sort of opaque when it comes to hydrogen. I think it will take a couple of years. Let's say I do recognize the issues with solar, but they can also be fixed by introducing further flexible power generation, for example. Yeah, it's very dirty, but having sort of gas-fired in certain critical things, I think there are things that we need to do at the European level to integrate the power sector much more than we used to do. I mean, when I started doing utilities 25 years ago, every sector, every country is very protective of its utility park. I think now in Europe, there is a mindset to look at things a bit more holistically. So there are other things in addition to hydrogen, flexible generation, better integration of the grid, better trading arrangements that can really help out, I would say, the introduction of solar.
Thank you.
Louise, allow me just to make just a quick contribution, because again, my view is that hydrogen is not just about future; it's happening now already. Maybe I don't know if the audience is. You have a US company called Plug Power, which is already providing H2 trucks and solutions for forklifts running at green hydrogen. So. And in order to not monopolize this discussion today, even though I'm seeing that hydrogen is catching a lot of attention amongst the participants in this panel, but maybe tomorrow I will have my colleague Christian Fuduk running a presentation dedicated to how solar can power green hydrogen, and that might be also a good opportunity to understand what is already happening and how we are seeing that this can be materialized rather sooner than later, as somehow can be the feeling or the sentiment around the green hydrogen. That is something that is only in the future. And if we combine this with the growing pressure on the price of the CO2 emissions, that is a problem that definitely is around the corner. And there are certain industries like ceramics, cement, petrochemical industries that they have to address a problem, and that will not come with the electrification. So this is a very important topic that we are in 2021, but this let's say this problem is around the corner that needs to be addressed. And unless the industry moves and somehow bring all the parties together and build up, let's say, what needs to be the constellation of the different stakeholders that need to participate in this new technology, if we can call it new, is something that is more a present discussion and than a future one.
Thank you. Yeah, some big challenges, but big opportunities too. David, just
okay. No, if I may go to the question on the size of the projects, what I would say is that, in particular in many countries, and countries that have, a lot of land like Australia or Mexico, Chile, or even some states of the US, I would say that the markets are competitive, are extremely competitive in terms of getting, a PPA, a long-term PPA. Also, there's a lot of competition, so there are not many players that can sign, large and long-term contracts for buying energy. And developing a plan of whatever, 30, 35 megawatts compared to another one of 100, 200, and in particular in the countries that I have mentioned. So there are clear economies of scale. You can get a lower LCOE, taking advantage of a single transmission line, a substation, and so on. So I would say that in certain countries, if land is available, so I would agree with what Joost mentioned. So in some countries, this is really not feasible, but in many countries, large projects will have a lower cost per megawatt, so will be more competitive, will be then able to get PPAs, then they will get better financing. So there is a clear, I would say, competitiveness in developing large projects in certain countries. So we see that smaller projects, also with the time that you have to dedicate to a small project, I think that it are less competitive. So we also see in the countries I mentioned, so a trend for larger plants.
Thank you. And I'd like to just move on now to that sort of contracting strategy and PPAs. I think it's very interesting times as the PPA markets are evolving pretty quickly and will continue to do so, I suspect. And indeed, we've got the sort of auction programs, which are sort of clouding that view as well, and laying into strategies for developers and financiers. And certainly we're seeing a sort of divergent of views to some extent from funds as to the value of certain revenue streams against variable merchant ones. Federico, do you want to just give your view around contracting or auction strategies?
How long have you got? Because I have very many, let's say, views on this. Let's start with saying that if it was for me, I would never enter PPA on my assets. However, many investors want the PPA, and then we need to look at what does that mean. That means that you are basically what you were. Let's start with what was the world pre-COVID and then what is in COVID. You were basically foregoing 30% more or less on the price of electricity to contract the power for 10 years. If you look at that on NPV value, that it's about 50% if you consider the life of 30 years of your plant. Now, in my opinion, it is difficult that you go negative equity in a merchant type of environment. And if your investment is made purely merchant and the price of electricity goes so low, I think that as an investor, you will have far more problems on the other assets that you have than on the merchant type of solar plant. But having said that, we have entered FORESIGHT many PPAs, and we've done it with utilities, we've done it with corporates, we've done it with traders. Now, clearly, creditworthiness of the counterparty is key, because we have seen during the pandemic that some PPA providers actually defaulted under their PPA when the price of electricity went down to 20%. Now we need to make an additional consideration. And if assume that I contract a PPA at 40 euros per megawatt hour, just to throw a number, and the market stays constant for 3 years at 20 a megawatt hour, I would bet that the big utilities that you have contracted with will call you and say, look, come here, let's renegotiate. And they will come with the banks that have financed your projects, and they will be much more aligned with the banks than with you. So at the end of the day, what is the advantage of having the PPA? Is just because your investor in its allocation of risk can say, well, actually, we have a creditworthy counterparty in that respect, and therefore we can, sue them and take them to court, in which you're probably going to win. But then that's not the way you're going to keep on working, because after you sue one of those counterparties, you will never enter another PPA in the future. So that's where the trade-off is. So we need to see how the PPAs will shape in the future and what will be the level of defaults and how we're going to manage that before saying that actually that is the solution. If we look then at the numbers of if all the corporates will want to enter a corporate PPA, that will cover just the 15% of the markets. Therefore, is PPA the answer? I don't know. I honestly don't know. I see this to become a much more merchant type of business than it was in the past. And I still don't understand why banks are reluctant to lend on these projects. If you consider the fact that the leverage on these kind of projects, if you want to maintain a yield, is between 40 and 50%. So if I am a lender, as long as I set my, let's say, triggers in terms of cash sweeps or defaults at the right way, I can work as a PPA counterparty. And therefore, I can see where the market is going and trending. And if we look at obviously, everybody has in their hands the studies from the market providers, and they're all the same. There's little differences. If you do like let's say an average of what the forecast is, you get more or less the same number in more or less every country. And therefore, I don't understand why the banks are reluctant, considering the fact they've been lending to merchants for years, on the gas, let's say, utilities that obviously produce gas. So that would be my view on the PPA. I think it's an overrated type of solution, but that's where we are. But that's my personal view, not necessarily Foresight view.
Great. I'm sure we've got a range of views on this topic, and the poor bank sometimes.
May I complement on, if I may, on what Federico mentioned? I mean, you're right, Federico. I would say just two quick comments on the bank position. I mean, it's not bringing them a PPA. That they will ask for the creditworthiness of the off-taker, the security package. I mean, there will be the warranties, the termination right. So they will scrutinize the PPA. So in the end, they clearly are concerned that if for whatever reason, the off-taker wants to terminate the PPA, in the end, there are warranties in place and that in the end will provide with the SPV with the right cash. So it's not only having a PPA sign. And I also agree with you that in the end, and the prices have changed and the market is changing, but there is a certain, let's say, the discount and advantage between signing a PPA and going merchant, but this has a limit. So, and I'm not going to say which is the percentage, but if a developer or an investor believes in that the prices will be at a certain level, so there is a PPA price that I would say will not compensate. To sign the PPA to get contracted revenues with more visibility versus all the, let's say, profit and money that you are leaving on the table signing a PPA. And clearly we've seen this in many countries that, large brands, I'm not going, but the classical, leading, American, companies, largest companies, also European, today are being able to sign, I'd say, very, very attractive PPAs for them. So, in terms of pricing, but I agree with what you mentioned.
Thank you. Michael, do you want to comment on this topic?
Again, I would somehow disagree with Federico. A PPA is a kind of hedging instrument, and it's not a decision between taking full merchant risk or signing a PPA. You have to look at it from a portfolio perspective, and in some cases it may really make sense to sign a PPA, in other cases not. So from a portfolio perspective, you have to somehow level your exposure to merchant power risk. And at the beginning of our panel, we talked about the resilience of solar assets during the pandemic. This resilience was more or less a result of that the huge portion of the operating assets have been backed by feed-in tariffs, or have signed long-term PPAs. And that was, at least to our understanding of the market, was the reason why we haven't seen such impacts in the solar sector compared to other markets. And when, for example, if you look at the Nordic market, this is not a solar market, but more or less a wind market. If you have been exposed to merchant power, you wouldn't have talked about resilience of renewable energy generation assets. Look at the Nordic power markets, the prices have dropped to 10 euros per megawatt hour. And this is definitely not sustainable for any kind of renewable energy project for the time being. So I believe that using PPAs is definitely a way to balance your portfolio and to manage your merchant risk and your exposure to market disruptions.
Thank you. Ivan, do you want to come in on this topic? Is the price that you pay for certainty worth it? And also interested in your views around the sort of auctions. We've obviously seen, you know, Spain, Portugal, but disappointing results in Italy. Just if you could comment on those topics.
Yes. Yeah, and I will link it to one question from, I mean, one response to Michael and Federico, because I think you're both right. So the auctions, I mean, we experienced something similar in Brazil and Mexico, right? You launched the first auction, the project got bigger, the prices got to the bottom, and then we end up having some customer of us saying, you know what, I'm going full equity. I've got merchant, I'm not gonna get just some financing for the VAT. And we built, I think, 6 plants in Mexico for one of our customers who decide, you know, to not to get financing, just to grab this value, because there was a distortion between the prices on the pool, if you can call a pool Mexican prices, and the PPAs, sorry, on the auctions. So when you have these differences, I agree with Michael, then PPAs are a mechanism. So back to your question, Louise, very quickly. So in Portugal, we have last year very, very low prices, 12 cents of euro back in the time. We were expecting in Spain something similar. We came a little higher, maybe not the same conditions, right, David? I mean, 10 years, 15 years versus 12, this idea of the interconnection rights for good. But I want to bring one question on for Federico and Michael and all of you. That was probably one of the first focus on the panel. So which is let's say what I see the future of this market, and what we've seen is this figure of Jen Taylor, like the generator that also sell electricity, and it comes on the both sides. We saw it in New Zealand, we saw it in Australia, we saw people like you know, KGAL and now I'm working on it, but we've seen a lot like the NGs and Statkraft moving on that way, and that's when you basically cover all, right? Because you have the asset, but then you go straight to the customer, and then you, yes, of course, rely more than on the bankability of the off-taker, but having a variety, abundance number of them. So if you have 2 or 3 that fails, you cover, like basically an utility financing model. I don't know if you guys are concerned about that, if you see that coming, if it's work or work not with your business models.
Federico, I'll give you the chance to answer back.
Well, let's answer to Michael and the hedge. I agree on the fact that obviously the PPA provides you a hedging, okay? But then I disagree on the fact that the resilience, it's only due to the fact that there was a PPA, in the sense that clearly if you enter the PPA, you did forgo that 30% that you would have cashed in for the previous 2 years. And then if you have a bad year, which we have during the pandemic, that would be fully compensated. So at the end of the day, if you look at the average, otherwise your PPA counterparty would be losing money, and they don't generally tend to lose money. And then in the long term, hedging works in the short term. Long-term hedging doesn't exist as a concept. I can't hedge myself for 30 years, which is the duration of the plan, or for 40 years in that respect. Then unsubsidized market, in my opinion, is much more a pure equity market. I think that you can start financing those type of assets when you start having 3, 4, 5, 600 megawatts. And therefore you have a natural hedging. And in that context, in that portfolio, it might make sense to do, I don't know, 50% PPA, 40% PPA, because then you have kind of that size. On a mono plant, in my opinion, doesn't make any sense. So I don't know if that answers your question even on this point. But clearly, there's a matter of perception, and there's a matter of investors' kind of targets. And investors today prefer to have a lower return with a fixed type of revenue than taking some risk. As I hear investors saying that they would like to have still double-digit return in renewable energy, but without taking any risk. So that's the kind of situation we face in ourselves, because there are managers that tell them that this is still achievable. And I don't know, I see also managers that are saying that they can reach single-digit, high-digit IRRs on current assets in a market in which there is an incredible kind of competition where we fight between 6, 5.5, 6.75, you know, let's extend the life of the plant to 45 years because, you know, we can do revamping 2 and 3, and they want everything to be priced today. So that's where I think we currently stand, and I think it's going to be an interesting dynamic going forward. And I agree with what was said before, that only the large managers, like all the ones that are sitting around these tables, are the ones that can actually face the challenges of the future, because only having a large portfolio can allow you to reach those economies of scale in terms of renegotiating some of the agreements, being capable of contracting like larger volumes of PPAs, because even the PPA providers are not interested in giving you PPA for the 5 megawatts. They want 200, 300, 400. So PPA providers are actually seeking for renewable energy, also because from an ESG point of view, even their customers want to have renewable energy going forward. So that's the kind of market dynamics that we will see in the future.
Thank you. João, do you want to come in? Sorry, do you want to come in on this point?
Let me just give my brief contribution on this. What we can see is a endless discussion, PPA versus merchant. But again, we at Smart Energy, we see actually that going for a long-term so-called bankable PPA is somehow giving away a substantial part of the value that you can extract if you look to an horizon of 30 years. And we see that maybe you can have a partial coverage through a PPA, and then allow you to also to profit or to take the downside if it happens in the merchant. But again, this might be also there is an alternative of doing like your hedging by combining, once again, having the direct access to the market, to thousands of customers, as we are doing our path with our retailer in the Iberian. And again, sorry for bringing again the discussion or the topic of the hydrogen, but as some players, including ourselves, are planning to sit the hydrogen projects next to our renewable assets, wind or solar, there is also a very interesting way of hedging yourself by, as you know, the hydrogen needs the low cost of energy. So in a way, if somehow you will not extract the value from the kilowatt hours that you generate in your wind or solar plants, that will be of use in the hydrogen that requires low cost of energy. So again, it's like a natural hedge, if we can call it like that. And then if finally you decide to go with not so bankable and reliable off-takers that gives the predictability that the banks, the financing institutions always like to see in the project finance non-recourse, you are down to managing the risk of insolvency on the other side. But again, it's something that, depending on the way you structure your PPAs, can bring to you, of course, a hard time during a couple of months, but it's something that then you can figure out and gives you this freedom and this liberty of at all the time being actively managing the way you extract more value from the project.
Thank you, David.
Yeah, just adding two points. One, and I mean, in the end, I mean, PPA, it's true. I mean, this provides, I mean, visibility and predictability of cash flows. And in the end, it's not black or white. I mean, a company, I mean, may decide to hedge 100% of the production, may decide to hedge 50%, 60, 70. It's true that there is a threshold below that you will not be able to get financing. But also if PPA prices are, I would say, very, very attractive. I mean, we usually may go to a large percentage of PPA if we see in that in a moment or in a market that PPAs are not as attractive. So then, I mean, the logical decision would be to go with a lower percentage of PPA. So in the end, we can have both worlds, and that was, I think, was Joost was mentioning Michael in terms of, I mean, having some merchant exposure when you have more risk, but you can get higher revenues and a higher profit, and then hedging a part of your plan with a secure PPA. And on top of that, and as we have seen this in, I mean, not in physical PPAs that usually off-takers want, I mean, a fixed price, even with no escalation. I mean, we've seen other more sophisticated, let's say, financial PPAs where you can even agree not a fixed price, but with a collar. I mean, with combinations of caps and floors that in the end, I mean, going to Federico's point, I mean, both off-taker and the PV, the plant owner can also take advantage of higher prices than getting a higher price, and on the other hand, if prices are lower. So in the end, the volatility of the price is somehow, I mean, balanced between both parties. So I think many we would even believe that as we have seen in the, for instance, with interest rates and with the financial markets, we may see that this market may evolve. And some financial players may want to provide, I mean, different sophisticated hedgings to the operators.
Just to add to that, I think, look, I mean, one thing that we have to keep in mind, I mean, I think Federico mentioned that clearly it very much depends on your risk and return. So I think all players today, including financial investors and institutionals, they don't talk about returns without risk, let's say. So clearly, and your risk appetite really depends on your skill set, right? So if your skill set is, let's say, a large sort of utility, clearly you have in-house trading, you have a big portfolio, you take a holistic view. If you're a financial institutional investor and you own one solar power plant, your risk is completely different than if you have a long short position across Europe and sophisticated. So that's the first point. So clearly institutional investors that I work with, they prefer a PPA simply because it's a single power plant that they tend to own basically. And yes, they don't like the volatility and they'd like to see. Second point to make is I think there's a difference between sort of existing power plant and new power plant. I mean, a new solar power plant, large scale, 80 to 150 million, depends, right? I mean, it's a big decision to put that money literally into the ground on day one, going completely naked. And yes, let's say clearly we do the LCOE analysis and look how that matches up with the curves, but still I think it's infrastructure and with solar, your money goes literally into the ground on day one. And you need to be quite certain, let's say, that you put that money into the ground. So doing that without a PPA, I would hesitate whether that's a sensible thing to do. Doesn't necessarily be 100%. Third element to throw out there, hedging. I think I had an interesting call this week about sort of weather derivatives. So I would say that, which is in favor of PPA, that sort of the whole market, let's say, sort of merchant risk, storage, but also hedging, will incredibly quickly become significantly more sophisticated. So clearly electricity, the big holy grail is storage, unlike oil and gas, which could always be stored. And therefore there was a large sort of derivative market around it. I think with the introduction of storage, that whole derivative market is going to go very, very fast. And with big data and better understanding of weather, I would say, let's say that very quickly, I think there will be a role for PPAs, providers, financial services providers, insurance, that do sort of weather derivatives on top of that plus storage. And very quickly, I think we can offer to institutional investors that sort of, predictable cash flows for investors that want that. Not everybody wants that, but institutional investors typically tend to look for lower risk. And yes, they are happy with lower returns.
Thank you. Yes, just conscious we're coming up to time now. But just wanted to end the discussion with a very quick fire round. Can returns go any lower? So quick, David, go.
I mean, I think it's, again, as that was mentioned, a risk return profile. So I would say that, I mean, we've seen countries like Japan where, I mean, permanent, I mean, rates are very, very low. But I mean, there will be always, I would say, I mean, a floor, if I may say, that's bond rates. If I may give more unorthodox answer to this, I mean, bond rates that it's theoretically risk-free rate. I'm not going to say that this is full risk-free rate, but it's risk-free rate plus, let's say, a risk premium that these assets have. So I would say this would be the floor. So if I mean, I prefer not to give any figure to this, but clearly, I mean that would be the floor. So risk-free rate plus a certain, I mean, we may call it this is 3-4% risk premium, but clearly the assets are. I mean, if one wants to take a decision where to invest, I mean, these assets have a certain risk compared to the bonds.
Great, thank you. I think we're all out of time now, so thanks everyone for a very engaging and interesting discussion.
Thanks very much.
Thanks to you. Many thanks.
Thank you very much. Thank you very much.
Thank you, Louise. Thank you.
Thank you, everyone.
Thank you, everybody.
So thank you very much for joining us for this session, and I hope you enjoyed the session. I think I would have liked to kind of have a hands up about whether or not returns could go any lower. So if you're still on the thing, thumbs up if you think they can, thumbs down if you think they can't, which is slightly counterintuitive. But thank you ever so much for joining us. We're now going to move over to a presentation from Longi Solar. So do join us in the virtual room where Vitor Rodriguez will join us as a speaker, and he'll be looking a little bit at how investors can overcome the LCOE challenge. So what kind of technology would better fit investment? Thank you very much for joining us, and we will see you in the other room. Thanks, everyone.